Stocks managed to eke out a day of gains, so are we really in the clear? And is the sell-off we've been watching through September finally over? Well, the global economy doesn't seem to think so. We are looking at the conclusion of the reporting period for Purchasing Manager Index data showing us where global economic conditions sit, and the view is sobering to say the least. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we are going to have a look here at where the global business cycle stands and whether the markets really have something to cheer about for longer than a day or two. The evidence seems quite dark, but of course that doesn't mean that the markets can't rally, and it doesn't mean that there can't be a resetting of sentiment that ultimately gets people to think things are cheap again. Markets are not the economy are not the markets exactly. Markets are more like the expectations for where the economy is going and investors' level of comfort with that. So we're going to look at what's going on here, and then we're going to look at why investors might be comfortable or uncomfortable with what's going on. Let's see what that might mean going forward. As ever, if you're watching this on YouTube, do jump in the comments. All your thoughts welcome here. Do you think the global economy has turned a corner? Do you think it's heading lower or higher? Do you think the markets will like it or not like it? Do you think stocks have bottomed or have more to lose? Definitely jump into the comments, share your thoughts, and we'll incorporate them into the show. So let's take a big picture snapshot look at this first and foremost and get a sense of where we've ended up now that the PMI roundup for September is fully out. And by the way, this comes from a whole host of publishers, including mostly S&P Global, and also some of the secondary or alternative publishers. For example, in the U.S., we have ISM data from the Institute of Supply Management. In China, we have data from the CFLP, which is the local logistics organization, which produces this in concert with the National Bureau of Statistics, so Chinese government versions of PMI. All of it is now out, so we can really get a good sense. This particular thing is the S&P Global and JP Morgan catch-all for the world at large, and it is not looking all that rosy. What we see here is that the cresting in the rebound in the service sector globally continues. The trend slowing a bit, but nevertheless, growth weakened again in September, and at 50.5 on the composite index here is devilishly close to standstill. 50, of course, in the logic of PMIs, is neutral, neither growth nor contraction. Under 50 is shrinking. Above 50 is expanding. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. We see here manufacturing has been in contraction territory for quite some time, really going back over a year now. That's that red line under 50. Services had a nice pop starting at the beginning of the year, but that's already come undone. It basically ran out of runway in May. When we look at the global averages and when we look at various economies, for some it's sooner, like China, for others it's later, like the US. But whatever economy you look at, the story is the same. What's more, it's the same across market groupings. Looking at developed markets here, same story. Manufacturing in contraction, services coming apart. As a matter of fact, because Europe has already been shrinking for 3 months, according to this data, we already have developed markets as a grouping shrinking. You can see here that thanks to that weight from Europe, developed economies, rich world economies, are already in contraction territory on net, and that's because services have basically slowed to standstill while manufacturing remains in contraction territory. It's a little bit better tidings for emerging markets. They're still nominally growing. Of course, we can see here that the swings have also been far less wild. So we haven't really gone very far. Compare that with developed markets where we had big upswings last year, PMI numbers north of 60, and then an aggressive climb down, a fairly pronounced bounce, and now a fairly pronounced reversal. All of this largely reflecting the excess stimulus in the developed world as relative to the emerging world. And that, by the way, doesn't mean that there was too much stimulus or too little. It just means that there was more. There was much, much more stimulus, especially fiscal stimulus, done through the COVID period in developed markets than emerging markets. And so, of course, the swings in the business cycle have been more pronounced as that stimulus first came in and then came out. So when we look at emerging markets, yes, there is growth. We still have that same story where we have anemic manufacturing, a pop in services, and now a climb down. But at least growth is positive. This is not exactly as good of a story as it sounds, because, of course, many of these economies are vendors for the developed world. And so if we're already seeing contraction in developed economies, and these economies in the emerging space depend on that demand, well, then once that slowdown works its way through a reduction in backlogs, a restocking of inventories, a renegotiating of contracts, that loss of demand will invariably show up here as well. And one might argue is already showing up here with the deflation on the services side and the slowdown in composite metrics that we see already. We know this story in spades when we look at China. China, of course, delayed its reopening by close to 18 months as relative to its main customers in the U.S. and the Eurozone. So, of course, those customers had ample time to start to diversify supply chains. So when China finally reopened December of last year and said, hey, we're open for business, come on down, demand was not there. It's certainly also helped that during that time, central banks in the developed world, and because of that outsized fiscal stimulus, were already dealing with an inflation issue with an aggressive array of rate hikes, obviously led by the Fed. And so post-catch-up growth, that burst of growth after the reopening from COVID in the U.S. and Europe, that crested already somewhere around the middle of 2021, as we can see here. Earlier in the U.S., a little bit later in Europe. By the time China rejoined the party, that demand was just not there like it was before the pandemic. And so here is a very clear microcosm of what happens in the broad emerging versus developed market dynamic. If developed market demand isn't there, well, then emerging markets have no one to sell to. And then, of course, the question comes, where do they get growth then? This, of course, is a very ominous story for the global economy as a whole, where, based on the latest numbers, about 50% of global growth is just three economies, the U.S., the Eurozone, and China. The rest of the world is about the other 50%, but of course, as we've just said, they're vendors to the other half. And so the impact that China, the Eurozone, and the U.S. have on the overall trajectory of global growth is tremendously outsized, much bigger than the 50% share that they nominally have. And that's not difficult to see. We of course, can see that Australia has this relationship with China, that the countries of Central Europe have this relationship with the countries of Western Europe, that Canada and Mexico have this relationship with the US, just as some examples. This, of course, is a troubling story because China, as we've just seen, is struggling to get off the mat. The splashy reopening that everybody was hoping for because of this sequencing in demand never actually occurred, and China is struggling. The Eurozone, as we've just discussed, is already shrinking and is probably going to be confirmed as being in recession when GDP numbers catch up to what the PMI numbers are already telling us. And so for some time now, the U.S. has really been the last leg upon which global growth can stand. But the problem here, of course, is that the Fed is laser focused on weakening it because it still has an inflation problem to contend with. Now, from the Fed's perspective, the issue is summarized something like this. The green line here is the 12-month forward view on where the Fed funds rate will be a year from any given point over the course of this year so far. So if we started in January of 2023 and looked out 12 months from any given day, that's what we would see as the market's expected Fed funds rate as it is priced into Fed funds futures. And we can clearly see here we've been on something of a roller coaster ride. We started the year with a push into the mid-50s, exactly where we, as a matter of fact, sit currently. So rates were not up here yet, but we, of course, already got into this 525, 550 basis point range. Then the SVB banking crisis occurred, as did the issue with the U.S. debt ceiling, at least that round of it. And we can see with the banking crisis, expectations collapsed. Markets started to expect significant cuts, with rates coming down aggressively into the mid-threes within a year. As the issue with the debt ceiling kind of festered, that held, and then it became clear that a deal would get done. And so we've seen a recovery. And now the markets have adjusted to much higher rates in 12 months' time than they thought even just a few months ago. But the impact on inflation expectations has been, let us say, disappointing if you are the Fed. Now, most recently, there's been a bit of a pullback in inflation expectations, largely since the Fed announced on the 20th of last month that it's going to keep interest rates higher than the markets have been expecting, and for longer. But we still are looking at a situation where the Fed is not on target within a year. And within 2 years is just barely there, which gives them absolutely no room for error whatsoever. So if anything at all proves to be more inflationary than expected, be it another shock to energy prices, either from OPEC or from the ongoing conflict between Russia and Ukraine, be it, for that matter, a shock to wheat prices from that same conflict, be it some sort of other thing that we haven't yet contended with, but which might in fact strike as we have continued political turmoil in the U.S. We've just lost the speaker. We have an election coming up. All kinds of things are afoot. So with all of these moving parts and certainly continued issues in China, all of that to boot, the Fed is right on target. And nothing can happen for 2 years to move the ball, or else the Fed needs to do more. And that, of course, is not where they want to be. With growth slowing, they would much rather cut into a rise toward the target. But that's clearly not what inflation expectations are telling us, even as Fed rate hike expectations, or at least Fed rate expectations, have all but fully recovered from earlier losses and now stand at the highest levels that we've seen for much of the year. So even as the global recession becomes more biting, or at least the slide towards it becomes more concrete, and the global economy grinds to essentially near standstill, as we can see right here, the Fed still looks at this and says, well, clearly we've not done enough yet, so we're not going to cut. Perhaps we're not going to hike, but there's no cuts that are coming in any kind of a near-term sense. That, of course, has understandably spooked markets. Now, for the Fed's calculus to change, it needs to be making some sort of progress on the big block of inflation that's baked into the service sector at this point. We can see here, headline inflation has been cooling. That cool off has primarily come with the shrinking of goods inflation, which you can see was a much more meaningful contribution here, in which, thanks to Fed action through the course of last year, has been now squeezed to next to nothing. Energy has perked up a little bit with OPEC's latest machinations, or at least the market's belief in OPEC's latest machinations, for now anyway. But energy is still on net pulling down inflation to a much lesser extent, and that's arguably why we have this little uptick here in headline numbers. But for the Fed, there's nothing to be done there anyway. They can't influence global energy markets in any kind of direct, unobstructed way. And so what we have here is really what matters. And if we break down the service sector, we can see the majority of this is actually housing. And that housing is as much of an elevated cost as it is largely the Fed's own doing. Most mortgage rates in the U.S. are fixed rate mortgages. And so if we look at where most people have their mortgages that are already outstanding locked in, the average rate is about 3.6%. Meanwhile, the Fed's rate hikes mean that the average rate available now in the markets is about 4% higher, at close to 7.6%. Not surprisingly, that means nobody wants to sell their house, because getting the next one thereafter is a much more expensive kind of proposition. So not surprisingly, housing inventory has collapsed, and the prices of homes, because they are not being sold, are not adjusting lower. And so we have this inflation stuck here until the Fed cuts. But the Fed doesn't feel itself ready to cut until it has seen inflation expectations actually respond when rate expectations rise, which, as we have seen here, the Fed has had some trouble with, to say the least. So what can the Fed do? Well, if it can't do much about housing because its own actions are keeping it illiquid and thereby keeps the prices up, well, then the one area where the Fed could still do something is the remaining sticky portion of inflation, the one that's locked in the labor market. Here we see that there is still a meaningful deficit that has underpinned wages. So we still have a shortfall of workers. Supply is still undershooting demand by something to the tune of 2.5, 3 million workers. Now, that's, of course, down from the 6 million peak that we saw in 2021, which is welcome news. But much of that has come by way of reduced openings. The way that we construct labor supply and labor demand here, labor supply is the labor force. Everybody who is employed and everybody who is unemployed but looking. So the traditional definition of unemployed, that's the supply of labor. Demand is those people that are already working, and job openings. So those people that companies want to be working. And if we look at that, the gap is at this point about 2.5, 3 million. It has come down from 6 largely because job openings have been trimmed. So demand has been reduced. But that doesn't really do much to unlock inflation, because the big issue is the jobs that were created through the COVID period, where these shortages were at their most acute, inflation was on the rise, the employment cost index, the yellow line there, was on the rise, and so wages were locked in at high levels. Until you get layoffs, and not just a reduction in job openings, those wage agreements don't reset. And that's how you have the employment cost index down less than 1% of its peak, whereas inflation has come down by much, much more. CPI is down from 9 to just under 4. The PCE index is down from 7 to about 3.5. Much more pronounced declines than what we've seen for employment costs. So for the Fed's perspective, this is where you have agency. If you squeeze the economy enough and there are layoffs, then you can unstick enough of the inflation locked in markets to start to get expectations moving lower, or at least so goes the theory, and then you can begin cutting, which unlocks the rest. So how prepared is the Fed then to come and rescue the global economy? Well, the latest set of ISM numbers, going back to our activity surveys, would suggest that it's not nearly close enough. In September, what we saw was not only did employment in the service sector continue to grow, but the manufacturing sector returned to positive job creation for the first time in 3 months. So we now have coordinated jobs growth across sectors of the U.S. economy, something we haven't had for a few months now. Not surprisingly, the cost structure has continued to hold up, in particular in services, which of course is the place where we want it, or if we're following the Fed here, where you want it to give way. This, and of course the service sector is about 70% of the economy, give or take 75, to manufacturing's 20% or so, with the rest made up by agriculture, and of course we're rounding. But if we look at what's going on here, in this ISM data, we have a labor market that doesn't look like it's ready for layoffs, at least not yet, and thereby a cost structure which in manufacturing is starting to idle here, and thankfully is at least in contraction territory, but of course that's goods inflation, and we know about that. That's been shrunk to nothing. But the service sector is not only not falling, it's actually been going the wrong way for the past several months. And so the Fed is ostensibly not in a position to actually do any cutting. Now, we do see some early evidence that the pain in the U.S. economy is starting to compound. The new orders component of this story is starting to roll over, perhaps. Orders have been shrinking on the manufacturing side basically since the middle of last year, but in services, they've been much more robust. In these latest numbers, they take a significant leg lower. And of course, if new orders are down, that would imply that business is down. That would imply that demand is lower. That would imply layoffs eventually, if it continues. And perhaps that's the Fed exit from all of this. But In the meantime, investors are understandably spooked because ever since the Fed met last month, it's told markets, we're not going anywhere fast until this rolls over. And the markets are looking at the evidence of a gathering global recession and saying, we need help now. And so, not surprisingly, what we've seen is a steepening, a bear steepening of the yield curve, where more uncertainty, more term premium or additional compensation for longer lending periods enter into the bond market. So front-end yields have held steady because the Fed ostensibly isn't hiking, but it isn't cutting. But the long end has blown out because more uncertainty is being baked in. In fact, the Treasury term premium has turned positive for the first time in ages as the markets start to look and say, well, if I'm going to lend over a 2-year period, there's not that much uncertainty, but over a 10-year period, a lot more. Because we no longer have confidence that the Fed is going to get out from a tightening bias soon enough that there won't be a global recession that knocks everything down at the same time. And so there is a perception of extra volatility and of extra risk in whatever happens with the economy and with rates. The relief valve here, ostensibly, would be for the Fed to see enough economic pain that it could bring rate cut expectations forward and actually begin to signal that they're coming. But if we look at current expectations, that is not where the market sees the U.S. central bank. At this point, we're looking at cumulatively about a 43% chance that there is a further rate hike this year. Now, that's cumulative. At November's meeting, the probability is only 24%. At December's, it's only 18%. So the market is still very much tilting toward there not being any more rate hikes. But rate cuts are pushed quite a bit down. The first cut is fully baked in here by July. That's one full cut in and about a 20% chance for a second. A second cut is there for November. And then there's about an 80% chance of a third before year end. Now, if we continue to get economic data, and we saw this in spades with JOLTS job openings data earlier this week that registered higher than expected and spooked markets. If we continue to see the kind of things that these ISM surveys are showing us, which is still positive and resilient job creation and still sticky service sector inflation in the U.S., well, then the Fed is going to, as the cliche now goes, hold higher for longer. But in this environment where global economy is already at a standstill, China can't get off the mat, and the Eurozone is already shrinking, this is a recipe for global recession sooner rather than later. And so from the perspective of investors, until there is a clear sign that the Fed is finally prepared to turn a corner and own that commitment, stock markets are probably still biased lower, because where the collision of a Fed that's dithering and a global recession already on the horizon ultimately shakes out, and how bad of a proposition this is going to be for consumption and thereby for earnings and thereby for markets. That's uncertain. And that uncertainty itself, the Fed's willingness to whistle past the graveyard in the face of mounting economic pain, that's enough to keep investors defensive all by itself without evidence of an imminent collapse. And it is, of course, through this lens that we watch incoming economic data from here. Most notably, of course, at the end of this week, we will get September's U.S. jobs report and see where we are on all of the various labor market variables that are so critical for the Fed in making this decision. But that is a conversation for Macro Money tomorrow, where we will do a deep dive on the U.S. jobs report due on Friday. In the meantime, this wraps up our discussion for today. We're here Monday through Thursday every week, right after overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live, where we're increasingly joined by the great Dylan Radigan to discuss what happens at the end of each Wall Street day and what that might mean going forward. I'm on with Chris again on Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sundays, writing for the news and insights section of tastylive.com. In fact, the summary of this very conversation is there already. And of course, opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Happy trading. Do jump into those YouTube comments with your thoughts. We'll be back tomorrow. Take care.